Hello guys, this is Alex again here, trying to cover monetary policy and bank regulation, okay? I hope you guys are safe, back home, and everything is fine. So I'm gonna try to do a different approach this time. Instead of just recording myself through the lecture, I want you guys to watch a few videos first. Those videos are already posted on Top Hat, so please watch the videos first and then come watch my video so you guys having a better understanding. So today I'm just going to do more a summary of this chapter, instead of going over, since there's a lot of good materials on the internet, and I do believe if I just record myself again, it'll just be quite repetitive. So people already did an impressive job on YouTube, and I'm not trying to redo the same thing, right? I'm just trying to give you guys a like a better insight to understand the material, okay? So this week you're gonna cover monetary policy and bank regulation. So as we saw the previous chapter, we're talking about money in bank, right? So money in bank, we cover about the Federal Reserve, in other words, the Fed. So the Fed has a few goals. First goal of the Fed is to conduct monetary policy. Okay, so what is monetary policy? It's type of policy that's trying to involve the money in the economy, even to contract the amount of money we have in the economy, or to expand the amount of money we have in the economy, right? According to the level of the money we have in the economy, M1, M2, and so forth, we might impact the aggregate demand, to expand aggregate demand, or to retract aggregate demand, right? So this might have impact in the economy. Also, the Fed has the goal to promote the stability of the financial system, right? So in other words, have to promote in a way that you guarantee the financial system is wealthy. It's not going to just bankrupt in a few years from now on. So the Feds also oversee how banks are managing their assets. If they are having more assets than liability, right? When they have more assets than liability, the bank is solvent. When it's the opposite, the bank is just insolvent. So the Fed is trying to oversee if the banks are solvent or insolvent. And lastly, the Fed also works as the last resource to lend money to banks. If the banks are going about to go under, what the Fed goes is to do is trying to lend money from those banks in order for those banks to survive, to not just bankrupted. Because we know if a few banks bankrupt, it might have a huge impact in the overall bank system and as well in the economy. So the Federal Reserve has this power trying to intervene in how the banks are supposed to bankrupt or not. So it's an important role in order to guarantee the stability of the overall economy. Okay, so you guys are gonna read those slides. It's already posted on Top Hat. I'm just gonna do a review here again. What else is important here? So when you're talking about bank regulations, we have to understand that the Fed is trying to regulate how banks behave towards buying assets or giving towards loans to people or to firms. So in other words, if the banks start giving loans to people that are quite risky, in other words, they're not able to pay in the future, the banks probably taking too risk actions. So it might be impact in the future, and the bank might becomes more insolvent. So the Fed has to create regulations in order to avoid those type of behaviors, right? So the Fed has to improve its goal, not improve its goals, in other words, but it has to oversee how banks act in order to guarantee the whole financial system or the bank system does not collapse in the future. These types of requirements usually are more towards reserve requirements, as you cover in money bank. So the amount of money the bank has to keep from savings, right? Others about capital requirements and sometimes restriction types of investment. As I said, if they're trying to buying a lot of really risky type of bonds, so the Fed has to oversee how banks are behaving. In other words, how to regulate them to avoid those types of situations. 2008 is a great explanation of that, right? How banks behave really inappropriate, in other words, really risky, and we know what happened. we have a huge impact in the bank system, which translates to a huge impact to the economy. All right. So what else I want to talk to you guys about it? Let's go over here, the slides. So bank run. So imagine that there's a rumor that Chase is about to go under. In other words, go bankrupted. So imagine you have a saving account with Chase. So as soon as you hear this rumor, what are you gonna do? Me, Alex, what I do, I would just run to the bank, to the ATM, withdraw all my money that I have from the bank. Imagine if everybody does that. Do you think the money is gonna have enough money to pay, to give the money away? Probably not. So in order to avoid those types of like bank runs, or to guarantee that if a bank actually bankrupted, people are not gonna lose the money, Fed create a quite nice tool called the deposit insurance. So deposit insurance right now guarantee that if you have up to $250,000 on your bank account, if the bank goes under, so bankrupted, you're gonna still have your money back. If you have $1 million with the bank, you're just gonna have $250,000 back. At least is a net safe that trying to guarantee that you don't lose all your assets at once. So just trying to make sure the Fed actually trying to avoid if the bank goes under, the population actually also get a huge impact, right? However, when you think about it, what is the positive and negative side? So the positive side is that banks, even though when they go under, the population is not affected, right? So it's a more powerful, more reliable bank system. But if I'm a bank and I might not care enough about the financial conditions of the bank, or in other words, not the bank itself, but the people who has accounts with the bank, right? So the depositors would not care if the bank goes under or not, as long as I have less than $250,000. I'll just deposit my money in any bank because it's guaranteed if that bank goes under, I'm still gonna have my money back. So people sometimes do not oversee or trying to make smart investments in really sketchy banks because they know they're gonna get their money back, right? Also, we know that the Fed works as the lender of the last resource. In other words, when the whole financial system is going down, banks are about to go bankrupted, what they do, they're trying to get money from the Fed, right? So the Fed usually buy papers from the bank in order to guarantee the money has enough funds or money to be sustainable, in order to keep operating, to not go under. However, if you think about it, this might be also has a positive and negative effect. The positive, you guarantee that the bank doesn't go under. In other words, people don't get laid off. We had a huge impact on the financial market and as well on the economy. But if there is a guarantee that the Fed's going to give me money, regardless of my attitudes, I might just be more irresponsible, right, or more risky. So in other words, the banks can take really risky actions because they know in the end they're going to be backed up by the Fed. So this is what happened in 2008, 2009. Several firms, actually they're about to go bankrupted. What the Fed did, started bail them out. Give them money to say, hey, do not break down, do not break down. And this has a huge impact because the Fed is a federal agency, which has the overall money from the country. It just focus on a few private firms. So this might have an impact in the overall economy, right? So a great question to come is that should taxpayers be responsible for the failure of the financial institutions? Me, as personally, I'm not sure. Sometimes I believe so. Sometimes I say I don't think it's that simple. So yes. So it's a great question. You guys can think about it, and we can discuss later on the office hours. So how we know the main goal and the regulation, how the Fed's overseeing banks, but how the central bank, the Federal Reserve, should execute monetary policies, right? We have two types of policies: expansionaries, in order to expand the money supply, and contractionary policy, in order to contract the amount of money supply in the economy. Okay, so as you watch those videos, we have the traditional monetary tools and the more modern monetary tools. So after 2008, 2009. So the traditional usually goes more to open market operations. In other words, what happened in open market operations? The Fed buys and sells treasury bills, or in other words, T-bonds towards bank. When the Fed actually is buying treasury bills from the bank, is getting the treasury bills from the bank and give them money. Doing that, the bank has more money, right? So the assets increase through deposits. So the reserve deposit actually increases, right? Because that's where the money comes. And then what the bank does, so they're just to guarantee the same level of deposit reserves, he started creating more loans to other people, right? So I had this extra money comes to my bank on my assets. For those assets, I just want to keep the same level of reserves. So these reserves can be turned into loans, and other people can get loans. In other words, it's going to expand the supply of money in the economy, right? Contractionary is the opposite. So the Federal Reserve is going to sell treasury bills, T-bonds. Banks are going to pay the Federal Reserve. When they pay the bank, we're going to have less reserve, right? With less reserve, what they do, they just decrease the amount of loans they're offering. In other words, they decrease the amount of loans, so people has less access to the monetary, or to actually less access to money, impacting the overall economy. Okay, so let's go over traditional economic policy as I just described. So selling and buying treasury bonds, right? When the banks buy and sell treasury bonds, the Fed can regulate what they call the federal fund rate, right? So if they want to expand, they start buying those these T-bonds. Buying those T-bonds, the overall federal funds rate decreases because banks house has more money on their hands to loan, right? So they can control, in other words, can tweak the overall interest rate in the economy, right? Because just if they buying or selling the T-bond, when they buy the T-bond, there's more money available to banks. In other words, more money available for loans. So the federal interest rate decreases. But when they start selling, they started selling T-bonds, they're getting money from the bank. Federal fund rates increase, it'd be more contractionary impact in the economy. Okay, so let's think about we're just talking about expansionary policy. We're just talking about Fed buying treasury bonds and all the impact. So please revise those slides here. It might be quite useful, but this is the idea: buying and selling T-bonds impacting the federal fund rate. In other words, impact the availability of money in the economy. Okay, so let's go over here. So what is a federal fund rate? Is a rate of interest that banks pay each other when they make overnight loans. As watching the videos, when the banks have overnight loans, they get loans to each other, right? So the bank A needs some money, they're gonna get loans from bank B. So these impact the federal fund rates. If the Fed wants to impact these federal fund rates, what they're gonna do? Either buy or sell T-bonds. Sounds good? So let's give an example. Let's assume that the Fed wants to do expansionary monetary policy. So right here, the initial situation, we know the bank has 440 million in reserves, bonds 120 millions, and loans 300 millions. Deposits, it has 400 million in liabilities. So the total net worth is 600 millions. All right. Since the Fed wants to expand the money on the economy, expand monetary policy, what they're going to do, you're going to buy bonds from the bank. By buying bonds from the bank, what the banks receive? Money. How they receive that? For the reserves. So the reserves increase by 20. Okay? But since they're selling bonds to the Fed, the total bonds we're gonna decrease by 20. In other words, the total assets will not change. We're just gonna change where the 20 go. So increments on reserve and decrease on bonds. Sounds good? Net worth still the same. So if the bank wants to keep the same amount of reserves, $40 million, what they're gonna do? Decrease reserves by 20, right? And then start giving more loans, increasing loans by 20. In other words, the total assets of the bank did not change whatsoever, but the amount of loans actually increase because the total bonds decrease. So the net worth of the bank is not changed whatsoever. But now there is more money supply in the economy, which might impact people getting loans, firms getting loans, and so forth. So in other words, the aggregate demand is going to shift to the right. Okay? So we might think, oh, how the Fed get money to buy bonds? Right now, they don't have to print anymore. They just have to click in the computer. I want to get the bonds from you. I'm just going to increase your reserves, since the Fed's the one who should hold the reserves from the banks, right? So Fed holds the reserve from the bank. If I want to buy bonds from you, if you want to sell, I'm just going to increase your reserves, the amount I'm going to buy, and I'll get your papers from you. It's that simple nowadays. You don't have to print money anymore. If you go in the opposite way, if you want to be more contraction, instead of buying, the Fed instead of buying bonds, they're going to sell bonds, right? Similar idea, initial situation, right? It's quite similar to their example before. So if the Fed wants to contract the economy, he's gonna sell bonds. So you're gonna sell 30 bonds to the bank A. What is gonna happen to the reserves? It's gonna decrease by 30, right? By decreasing reserves, what the bank is gonna do? We're gonna decrease loans to get back to the same level of reserves they had before, which was 40. In other words, the total amount of loans decrease. Net worth of the bank did not change, but the amount of loans that the bank has or would be able to offer decreases. In other words, it's contractionary, decrease the amount of money supply in the economy. It's how the more traditional impact of the Fed on the economy to increase money supply or decrease money supply. Okay. Let's see what else we can talk about. Reserve requirements, as we talk about money bank, is a lot of reserves, but usually this doesn't have a great impact on the aggregate demand. It's more towards to guarantee banks doesn't become insolvent, right? It's more like it's a risk management type of tool. Changing discount rate. So the discount rate, I would say, would be the weakest type of monetary policy, since when the banks getting money from the Federal Reserve, they have to pay interest rate. But since banks usually do not go to the Fed unless something is really bad, because if my bank goes getting money from the Fed, what's going to happen? Investors are going to realize, hey, Alex Bank, it's just getting money from the Fed. So they might not be in a good shape. They might create a speculation that my institution is not doing well. So usually Fed, this doesn't have greater impact because banks just go ask for Fed for money when the situation actually is pretty bad. Okay. Let's see, it's a good question here. So the central bank has raised its reserve requirements from 10 to 20, right? Reserve requirements increase. And the Southern Bank finds that it's not holding enough reserves to meet the higher requirement. Then what is going to most likely to happen? Right? So what they can do, they just borrow money from other banks, right? So it's just going to impact the federal rate, fund rate. That's simple. Simple as that. So let's see the monetary outcome. So here I'm going to draw for you guys to show you how would be the impact from a expansionary draw. Expansionary policy, right? I'm sorry about my writing here. It's not easy to draw. All right, so let's first assume that we're going to have interest rate, right, and savings here. So who demand loans? Borrowers, right? Because people want to get money, the ones who demand money. And who offers or supply money? The savers, right? So savers supply money, and borrowers demand money. So this is the market of loanable funds. Okay, imagine now the Fed wants to create an expansionary monetary policy, right? So let's assume that the Fed started buying T-bills, buying T-bonds actually, buying T-bonds. By buying T-bonds, we're gonna have, what is gonna happen to the supply of money? We're gonna move to the left, right? So this is gonna be 0, be 1. Move to the left. So we know the equilibrium before was S0 and I0. After the expansionary policy from the Fed, we know the supply of loanable funds would, actually this is 0 and this is 1. My bad, guys. Okay, so we know the total savings is going to increase. When I say savings, it's savings and investments, right? However, the interest rate is going to decrease. So what is happening here? Let's think. So the Fed is buying T-bonds from banks. Banks now has an increase on reserves, right? With the increase in reserves, what the bank can do, it can increase more loans to people. So in other words, can supply more money to the economy. So the overall supply curve from loanable funds is going to increase. So the total of funds for investment and saving is going to increase, right? If this happens, what is going to happen to the, just a second, what is going to happen to the aggregate demand and aggregate supply? I got it. So we know R here is going to be our level of output. This is going to be price level, inflation rate. We have AR, aggregate demand, and R, aggregate supply, or the short run aggregate supply. Okay, and these would be the long run aggregate supply, right? So now people has more access to loans. So what is going to happen to consumption? Increase. What will happen to investment? Increase. If I increase consumption, investment, what curve should change? Should shift to the right? Aggregate demand. It's going to be 1, it's going to be 0. So looking at the equilibrium, on expansionary monetary policy, the overall output of the economy increases, right? And however, price level also increase. So we're moving from this point to this point right here. So we have a higher output because we're expanding the economy through monetary policy. However, price also increase. Okay, if you look at the, so the slides here, we're going to talk about this, the idea how we move from the loanable funds graph, interest rate and investments, to the aggregate demand and aggregate supply. Okay, so thinking about that, we also can create an example of a contractionary policy, right? So let's create here an example right here. Let's do our loanable funds, right? First. So we have interest rate, saves and investment. We have people who demands money and who supply money to the bank. So borrowers and savers, okay? If A is a contractionary, not all the whole words because it's really hard to write with my mouse. So what is gonna happen to the supply of money? Let's think about it. So if the Fed said, I'm gonna start selling T-bills or T-bonds, the same thing, US Treasury bonds. The bank is gonna buy it. The level of reserves, the bank is gonna decrease. By decreasing, what the bank is gonna do is gonna decrease the amount of loans to compensate the loss of the reserves. When decrease the amount of loans, the supply of loanable funds move to the left, right? In other words, the investment level, the interest rate level change, right? Because the investment level decrease. However, the interest rate level increase, right? And what is going to be the impact on the aggregate demand and aggregate supply? So the impact on aggregate demand and aggregate supply would be quite similar. From actually, it's going to be the opposite what you saw before. Be patient with me, guys. So on aggregate demand and aggregate supply, aggregate demand, aggregate supply, with increase in interest rate, what is going to happen to consumption for loans? If someone has to get a loan to buy a house, a big car, or you know, it should be big, a car, or something like a little bit bigger, like as a refrigerator and so forth. So consumption decrease. What happened to investment? Decrease. So what is going to happen to the aggregate demand? So this is going to be our equilibrium. Aggregate demand decreases. This is supposed to be 0. Price level in 0. Output level in 0, right? If I move here, what happened to the output level? Decreases. However, price level decreases. So this is the impact of monetary policy, especially buying and selling T-bonds, how to impact the aggregate demand and aggregate supply. Sounds good? So it's pretty simple. You just have to understand how does it impact the interest rate from the loanable funds market, and then how to be translate into the aggregate demand and aggregate supply. So let's do a question together, right? If expansionary monetary policy is implemented, what do they expect economic outcome? So we have to do two things: the interest rate, the loanable funds graph, and the aggregate demand and aggregate supply graph, right? So let's start doing them. So this interest rate in investment, and this would be, I'm sorry about that, level of output and price level. Oh my God. All right. So we have demand, loanable funds, and supply of loanable funds, and aggregate demand and aggregate supply. Okay. So if it's expansionary monetary policy, what is going to happen to the supply of loanable funds? It's going to increase. Why is it going to increase? So the Fed's going to buy T-bills, T-bonds, right? The bank's going to have an increase on the reserves. With the increase in the reserves, what the bank's going to do, going to start offering more loans to compensate the increase in the reserves. In other words, the overall supply of loanable funds is going to increase, right? In other words, investment is going to increase while interest rate decreases, right? With more investment, with lower interest rate, investment increase, consumption increase. With those two increases, what is going to happen to the aggregate demand? Move to the right. What will happen to price level? In other words, inflation increase and output increase. So C would be the right answer, right? Because interest rate decreases right here. Inflation increases, right? Output increases. If you put the long run aggregate supply, if you're moving closer to the potential GDP, what is going to happen to unemployment? If the gap decreases, we're going to have less unemployment. So unemployment is going to decrease. So C would be the right answer. Right? It's that simple. You just have to do two graphs to understand this overall dynamics.